using just the profiles, everything from Asia into the AM, through the AM, and into the PM, even looking into the 1 minute time frame. So a lot of this is just really coming together. So test. Hey trader, this is it's all starting to come together. So let's track this AM session. So we first start off marking off all of our parameters. So we see that the Asian range dipped down into a volume imbalance. There was an order block right at the 50%. We are anticipating with a normal protraction profile that after the Asian range, we may see a small run up, but we are expecting right at 2 a price run lower. Now we have an SMT on the lows here, where price runs lower than the 2 o'clock low, price stamp down here. And what we're expecting is an aggressive run up, and then New York open, we will see a return to the high that preceded the drop down. So that run up, which is permissible, but it doesn't have to, we'll have a drop down into a discount array, volume imbalance in this case, and then we'll see a price run up. Now this gap right here is from my previous journal entries. I am reinforcing this idea of time over price. So that gap, there is stuff happening, like, you know, time is passing between the London kill zone end and the New York open start, and we're anticipating a run up above the highs and then a return to that high. So here we have it. That's right here. So let's get this mouse. Let's get this mouse on here. I think you should be seeing it now. So that's this high. We see the trading leg is defined by consecutive runs up, and we have a 50% mark, which is right in here. Oops, sorry. Which is right in here on this trading leg. And we're marking that out right at the 50% mark on that trading leg. So that is the high that preceded the drop down at 2 and is between the split, or that splits the run up. Now we're ignoring anything from 5 to 9. Great little way to reinforce the importance of time. So let's see what happens next. We see that on that price leg up, price defined comes above the end of the London kill zone, which is what we anticipate here. 9:30, price runs down, tags right into the breaker, which could be this highest high here. Tags into the breaker at 10:30, which is part of the trading leg, star for star. Then we get into the AM session. So this already is so much info just from the profile alone, pairing up where are the relevant time markers, what do we not want to pay attention to, and where will we see price return to if it were true. Now that might just be step 1. Step 1 is the validation of the normal protraction. There was no red folder news today, so we're not expecting anything too crazy, but step 1 is seeing that confirmation. Let's jump into the AM session now that we've got our pre-AM out of the way. So continuing to follow the outline, which is to mark the moments in time. Context tool that I've implemented is the implied fair value gap, downrange candle, 2 long wicks on either side, using that as an implied area to confirm either the bearish or a flip bullish. So in this case, this context tool is just a marker of an area where price might work its way into and then continue bearish, or work its way into and potentially flip. That's right here in the middle. Implied fair value gap is a 50% of the long wick on either side of a bold face candle. There's also a fair value gap in here. Kind of comes at a weird time, 9:45. So that fair value gap does get respected, runs the lows, which is what triggered the normal protraction profile. And then we see two very strong bullish candles. Don't quite shift market structure, not yet at least. So without taking that context tool, just to kind of get a bearing on price, we see that we finally have a market structure shift in the form of 3 consecutive candles breaking multiple buy-side highs. In particular, the swing high that formed the breaker, and then a fair value gap on the more relevant time leg, which is not the 9:30 to 10, but the 10 to 10:30 leg. So 10 to 10:30 is a price leg that we're paying attention to. We see a breaker formed. Price runs away, slides all the way through the AM high at 9:30, and the buy side liquidity left from the previous session, previous day. Price then drops back into, no surprise, 50% of the fair value gap and exactly to the body of the breaker. One more test of the fair value gap. I also like when there's a intermediate sell side above a discount. That one really helps with reinforcing that that's the area where price should run. We see that tag very nicely, and then we see a consecutive move away. Now this was a super dynamic day for no red folders on the calendar. Price then made an aggressive run all the way up to the yearly open. Nice little wick down on the yearly open to capture anybody who uses that as a marker. Slides through a daily implied fair value gap and makes its way all the way to a daily fair value gap and exceeding Monday's high. So a ton of targets got completely hit, making the high of the week right now on Wednesday. So we have the AM session run, we have the return to the breaker, we have that breaker delivering amazingly well all the way up to the daily fair value gap. Lunch price action is obviously bullish. We see that move aggressive, tagging the yearly open with a wick and then running very high. We're going to zoom in on the 1 minute chart. This entire fractal in the PM session is just a thing of beauty. So here we go. First part of this fractal, get into the PM session. We see that we slide through the daily implied fair value gap. So it looked as if price wanted to respect the high of that daily implied, makes a swing low, makes an aggressive run up, makes another swing low. We're waiting for after lunch is complete. So after lunch completes, we see consecutive runs up. We clear the lunchtime high, we get to Monday's high, and we're now looking at the discount area of the price leg that ran the lunch high. So in the profile for a 2-session up close, we will anticipate that a price leg will take the lunchtime high, and that price leg is our new dealing range. So in that dealing range, we have a volume imbalance and an order block. That order block is validated by a fair value gap above and the market structure shift. Price comes down into the volume imbalance as well as the order block. We saw that the first few candles gave indication that it really wanted to respect just the volume imbalance, but eventually we saw that slip into the order block proper, and incidentally into the top of the daily implied fair value gap as a inversion. So if the daily implied fair value gap were thought to be bearish and price ran away, then the next opportunity to right side that trade or get back into it would be after that market structure shift. You see that return down. That leg then clears the lunchtime high. So the lunchtime high tucked in between 12 and 1. We have another volume imbalance that gets respected. So as soon as that price action shift, we see the first volume imbalance, then we start taking the inversion. So whether we look at this as a reclaimed order block or we use a volume imbalance right at the lunchtime high, price then finally clears Monday's high with a little bit more conviction, makes a drop down back into this area of consolidation, and then finally hits its target on that daily fair value gap low. So this fractal now acts, or this price action now acts as a market maker model for a fractal. So we see price runs up to the daily fair value gap low, and leaves a fair value gap and a balanced price range. Intermediate shift. If you had that conviction, you could take the first position. My preference would have been after the secondary market structure shift bearish, clearing several swing points, returning into a fair value gap, split by a opposing candles wick is my favorite, which is an old low splitting a fair value gap, stop above the next swing high, and we see price slides down. High resistance liquidity run because there's a lot of consolidation, deep retracements, consolidation, and then we are targeting some area of sell side based on time. So here's the second side of that curve. So now that we've completed the buy side, now we're running the fractal of the market maker model. So we have price running down to these relative equal lows. The time is coming up to 3:30. So right in that final hour, we see that price creates some relative equal highs, makes an aggressive run down to sell side, clears the sell side as its target. 3:30, we're not surprised if we see profit taken on the shorts or some sort of continuation of the primary trend. So we have a market structure shift, 3 consecutive green candles clearing an intermediate swing high, return to a volume imbalance and an order block validated by the fair value gaps, and we see price run. Now, if you were still thinking that this was bearish and this fair value gap was relevant, then once price cleared that fair value gap right at that light bulb, candle close outside the fair value gap is an indication to pause. You could look back, see that there is a mitigation block, mitigate the order, and then run for the nearest buy side liquidity relative equal highs, and price finishes its macro right on time, 3:55 candle, 4 o'clock candle, and then hey, we're done for the day. So beautiful price action. You can even suggest the evaporation of price for the rest of the day, and that's tracking using just the profiles, everything from Asia into the AM, through the AM, and into the PM, even looking into the 1 minute time frame. So a lot of this is just really coming together. So really proud of you, trader. Just keep this journal going, continue to reinforce the process over the profits, and we'll continue to start seeing consistent results. All right, let's do it again.